Hi, I can see 30 attendants. That's a great thing. Good morning, everyone. My name is Abhijit, and today I'm going to present financial statement analysis, that is session 1. So we are going to cover financial statement analysis. Well, in between, just let me ask you, my screen is visible to all? Am I properly audible and my screen is visible to you all? Okay, great. Thanks, Anand. Okay, so we are going to start financial statement analysis today, and we'll cover statement analysis in 2 sessions. So in the first session, basically, we are going to discuss. I know there are people who might be aware of what is financial statement. They might be extremely thorough with different ratios, but still I'm considering, from the scratch, but definitely I'll touch some basic things and then we'll go for a brainstorming session. So I hope you have got the financials, right? You got the financials, right? Over the mail, have you got the financials? So I sent 2 financials. One is Afcons, another is Indian Oil. Have you got the financials? Okay, great. Thank you. So we are going to discuss today financial statement analysis. What is financial statement analysis? What are the techniques of financial statement analysis? Why do we do financial analysis? What is the objective? We are going to discuss different components of financial statement analysis, components of balance sheet, purpose of balance sheet. Then we will do a bit of analysis of balance sheet of Apple Inc., components of profit and loss account, objectives of profit and loss account. Then again, there will be a slight critical analysis of PL account of Max Electronics. Then we are going to understand what is the purpose of cash flow statement. We'll discuss a real life cash flow statement of a company. We'll discuss financial trend analysis and business performance. And then we'll go to Dupont analysis. And there is an extended Dupont method and ROE calculation. So these are the things which are going to cover in session 1. So in between, wherever you are getting stuck, please note down your queries. Then we are going to have a Q&A session where you can discuss all your doubts and I'll be answering. Fair enough? So this is something which someone of you might be knowing, someone might not be knowing, who is from a technical background or who is from a non-finance background. Financial statement analysis is nothing but a process of examining and evaluating a company's financial statements. It involves studying financial reports such as balance sheet, income statement, and cash flow statement. It involves interpreting financial ratios, trends, metrics to understand strength, weakness, opportunities, and risk. Now, when I talk about the strength and weakness, so what do I mean by that? Can somebody answer? Just unmute yourself and answer. So I know I'm going to discuss what is the objective of financial statement analysis, but before getting into that particular portion, would like to understand that why do we do financial analysis? How it is going to benefit for us? Can somebody answer, please? Just a discussion. This is not a classroom kind of environment. We all are from industry. Just a discussion. So please unmute yourself and give your thoughts. Would like to collect multiple thoughts on this. Can someone tell, please? Do not write in the chat box, please. Unmute yourself. You are not allowed to unmute. Okay. Understood. To know the company's current situation, right? So one thing is that I'm doing my business. So I'm on a regular basis, I'm doing transactions. But what exactly I am earning in terms of profit? Now, whatever my sales are, whether it is increasing or decreasing, if it is increasing, then also I need to know certain strengths for which it is increasing. If it is decreasing, then also I need to do a root cause analysis to understand why my top line is decreasing or why my bottom line is decreasing. Now, when I use the word top line, it means sales. When I use bottom line, it means profit. Now, coming to the ratios, ratios shows overall financial health. So we are going to discuss ratios in the next session today only. So where there are different types of ratios which talks about your company's overall financial health, be it in terms of debt repayment, be it in terms of operating efficiency, and etc. Right? So this is the purpose of overall financial analysis. Now, once we talk about financial analysis, it is not only restricted to analysis of PL account, trading PL account, and balance sheet. It is restricted to ratios and ratios. It is restricted to even trailing and forwarding ratios. And see the entire trend analysis for 4 years, 5 years. Plus, there is another reason. One reason is knowing the current condition of the company. Second thing is, you could find a situation where you need to give projected figures for next 4 to 5 years. So suppose you are going for a project, then you need to provide CMA data, or you need to provide, like, what do you say, projected financials. So in that case, based on the current trend, current figures, you can give a projected figures for the next 4 to 5 years. Financial statement analysis is a key component of that, right? Now, normally, as I told you, that we do trading and PL account analysis, we do balance sheet analysis. But what are the other techniques? If I talk about techniques, it includes ratio analysis, it includes comparative statement analysis, it includes trend analysis, common size statement analysis, fund flow analysis, and cash flow analysis. Now, when we talk about comparative ratio analysis is something which we are going to discuss in the next session. When we talk about comparative statement analysis, what do I mean by this? Any idea? Can you please put it in the chat box? What do I mean by comparative statement analysis? You can put it in the chat box. That when I talk about comparative statement analysis, what do I mean by this? Any idea? I'll definitely explain. Correct. So one thing is there, comparing current year results with the previous year. What could be another thing? What could be another thing? So it's your company, you are comparing previous to this year's data. But what could be another thing in comparative statement analysis? Correct. Peer comparison. Very good. Peer comparison. Very good. So two firms are operating in the same line. We are comparing different ratios. And also, why do we compare peer? What is the purpose of doing peer comparison? So normally there are certain benchmark figures. Yeah, so cost profit margins, understand. So there are certain benchmark figures for a particular sector. Now, that data is available in a centralized data repository, right? That for this particular sector, for an example, yes, absolutely, absolutely, comparison with respect to an industry and sector average. Now a sector average is, say, a current ratio maintaining is 3:1, whereas my current ratio is less than 1. That means I am quite okay. So repository means, suppose if you compare NIC data and there are certain government data source, where from at least you can get the benchmark, right? So you can check the NIC data. I don't know whether I'm sure you will be familiar with this national. So it's available. It's an open source. You can Google it. NIC data, you can Google it. Okay. So where you get to know around, say, around 20, 25 different sectors. So that is, but point is that in all sectors, what is a normal CAGR operating? An average of different ratios you will get. You just have to Google. And in case you don't get it, let me know, I'll give it to you. Okay. So this gives you a fair amount of understanding about different sector, different ratios. Now, I told you that it's open source, you can Google it. If you don't get, let me know in the let me know, I'll provide. Okay, you can do it later on. NIC is an open source. You can do it later on. Yeah, NIC. Yeah, I'll do that. I'll share the link. Not an issue. Okay. Next, because this program is CCRA, Certified Credit Research Analyst, what is the purpose of, you want me to show right now NIC? This is an NIC document. You have to thoroughly go through this. This is slightly old. This is available in open source. This is a quite big document. So you have to go through it. You will get different industry code. And also you have to bit Google. So you get to know about sectors, probably even if you don't get, say you pick up a couple of sector and then you go and check the overall CAGR. You get to know about different clusters. So you have to put slight effort in this. Everything is available on it. You have to put slight effort in this. So different clusters are operational in the form of, suppose in Maharashtra in the form of MIDC, in some other place in the form of different clusters, and each cluster is for a particular sector, for a particular industry. There are clusters which are developed, right? This will help you in getting an overall picture what is happening for different clusters, and especially if you are in SME or MSME underwriting, because we are talking about CCRA, what is Certified Credit Research Analyst, is nothing but you are going to be an analyst. You are going to be an analyst, and you need to know what is happening in the industry, right? So next thing is trend analysis. When we talk about trend analysis, that means nothing but you see the overall trend of the financials. So you plot, you pick up certain pointers like change in the turnover, change in the bottom line, certain ratios, which I'm going to show you the different ratios. So you have to pick it up, and then obviously, like, you can show whether it is increasing, decreasing. There are certain ratios which if it increase, then obviously it's not a good sign. Certain ratios which If they decrease, then also it is not a good sign. So kind of trend analysis you can do. Further, you can put those data on a Power BI for a better kind of analysis, which looks good. You can use Tableau as well, right? Common size statement analysis, fund flow analysis, and cash flow analysis. Now, when we talk about objectives of financial analysis, is one is judge the financial health of the firm. Obviously, we all know to evaluate the profitability of the enterprise. That is also known to us, to gauge the debt servicing capacity of the firm. Now, whenever you are getting, suppose you are a credit manager, you are getting a proposal from a company. What are the things you observe apart from financial statement? Though I am slightly, getting into other things, but those are quite related. So can you please, anybody from industry here who is into financial and who is into credit underwriting? So Rajesh, benchmark data is available. You have to do a bit of, you have to give a bit of effort. Benchmark data is available. Even incubator models are available. So you have to search a bit. Because NIC handbook is slightly old. It is not updated after. No, anyone from credit department who is doing underwriting already? Correct. Promoters background, industry outlook, collateral, very good. How do you know the financial statements are correct on? How do I know whether what I am showing? No. Auditor's background is quite an old concept, boss. There are a lot of window dressing happening. No. That's an old concept. Those days are gone. See, forensic report is something, for everything you cannot get a forensic analysis. Neither your bank or NBFC will afford to do that. What numbers? When we talk about cross-checking, bank statement is one. Okay. ROC search will give you nothing. It is the charge creation. That's it. Correct. GST data. GST data. So guys, there is a term which we create. So I myself is into automation of entire lending and credit process. Triangulation. What is happening? Why it's not getting? So triangulation is, I'm not able to send message anyway. Excellent. Yeah. Have you heard about this? I understand there are software for forensic, but every company cannot afford software for forensic. So last month from 16 to 18, there was a first FinTech festival in BKC, Mumbai. Around 250 odd companies were there. Somebody is into forensic, somebody is into providing alternate data sources. That's okay, fair enough. But triangulation, as anybody, Abhishek says yes. Abhishek, what is triangulation? What is triangulation? When I talk about triangulation, what is that? So there is something called my GST, then my financial, and then it's banking. Now, GST to financial percentage. GST to banking percentage. and banking to financial percentage. So you guys, you can see now, yeah, balance sheet PL cash flow is fair enough, but how do you know that whether that is giving you a correct figure or not? So this thing is right now adopted by almost all the credit underwriters to understand. So whatever is being mentioned in the balance sheet, even the banking can give you a pseudo transaction to inflate the transactions. So banking is also not foolproof thing. So do not only believing in banking and financial, try to get GST. But the challenge is when somebody is coming from unorganized sector. So GST is, I think, it's minimum 20 lakhs of transaction, 20 lakhs of turnover is needed. Because one might, three aspects of fraud in the sense, three aspects to detect fraud. Not three aspects of fraud, three aspects to detect fraud. So when we do comparative analysis between GST to banking to financial, so on an average, it could be around 85 to 90%. If it is around 85 to 90%, so you can understand, okay, fair enough, there could be some cash transaction, fair enough. So the balance sheet is not a full proof about your business operations. Any doubt here, guys? If there is any doubt, you can write in the chat box and then obviously I'll explain this or else I'll go ahead. See, whatever I will say in my webinars will be very much related to practical life because I'm coming from industry. So I will give you examples which are, so GST to banking means your banking credit and GST turnover, whether those two are matching or not. I can give you, I can do a pseudo one. Say for an example, for the entire financial year 2021. So you are showing, Anand, we will discuss that. So we are showing a total turnover of 1 CR. Yeah, that is what I am explaining you. Please understand, be attentive. Financial year 2021, as per the financial, I am showing my entire turnover is 1 CR. In the same financial year, my bank statement shows total credit from customer of 90 lakhs. And my GST statement shows total credit, total purchase, total sale is 85 lakhs. Now I have to find out triangulation. So GST to financial, GST to financial, right? It is 85%. Now GST to banking. %94 and banking to financial. It's 90%. Now, if you are slightly stringent credit manager, which turnover will you consider? say you are very conservative, stringent, that no, I am not going to. Yes, correct, Bharat. So if you are slightly stringent and slightly, conservative credit manager, or my company policies is like that, we have to be conservative and not lenient. In that case, I will consider my GST turnover. So I will consider sales might come to me and say, boss, there is a turnover of 1 CR. I'll say, no, there is a turnover of 85 CR, which is being reflected in the GST. Then something which you can also compare. Yes, right. GST to financial, that means GST data you are going to consider. Right. Now, there is another important thing is how do you analyze purchase? So I'm showing my goods purchase expenses was this much. Say in my PL account, I'm writing purchase of 70 lakhs. So when I talk about financial statement, Are Baba, GST form comes na 3A, 3B. You will get the direct turnover and also input tax credit. One second. You want to see? I'll show you. Yeah. GST 3A. Read this one. Total taxable value, integrated tax, CST, UT tax, says. So when we talk about total taxable value, this is the sales portion, right? Total taxable value is the sales portion, right? So we will discuss about different GST also in the later stage. No, you don't need to compute this. Whatever sales you are making as GST at 3B. So whatever sales you are making is total taxable value. So what happens, the other way of calculating is if you are having 18% GST, and if you get the GST figure, then also you can calculate it. Right. So what I was, okay. So now what I was saying is purchase. So in the PL account, if you get purchase of say, Bharat, can you keep your queries for the Q&A session? So please keep your Q&A, this thing for Q&A session. Okay. How to handle sales returning back from distributors after billing. So that is something, from the tax perspective, if you ask me, so first of all, this will be written inward from the balance sheet perspective. From the tax perspective, it will be a set of things that, some what is mean by we can't GST alone means? Yeah, please keep it for Q&A session. Okay. Now, when I talk about purchase, how do you validate purchase that whatever purchase is showing is actual or not? In GST statement, something you will get, that is input tax credit. Right? Now see my input tax credit, if it is 70 lakhs, that means, or my input tax credit shows X amount, that means X amount is my purchase. Right? Now input tax credit means whatever tax I have paid, I am taking return for that. Right? So if my tax is say 18 lakhs, which I am claiming as input tax credit, what can be my purchase? This is my input tax credit. I hope you guys understand how GST operates, right? Anybody who doesn't understand how GST thing operates? Yes, 1 crore. So that means my purchase is 1 crore, considering 18% as GST, right? So next is to understand a long-term and short-term solvency of the firm to know the return of the capital employed or invested. So we are going to look at three main components of financials. One is trading and profit and loss account, balance sheet, cash flow statement. So when we talk about trading and profit and loss account, definitely we all know that it is companies' revenue, expense, net profit, net loss. It is structured into two components, trading account and PL account. When we talk about balance sheet, the statement of financial position on a particular day, and the components are assets, liabilities, and net worth. A cash flow statement is statement of financial statement that provides information about the cash inflows and outflows. It has three components: cash flow from operating activity, investing activity, and financing activity. Now we are going to discuss all these things in details. Don't worry, right? So as a bird's eye view, I have tried to provide the components of the balance sheet. So one is assets, liabilities, owner's capital, long-term liabilities, current liabilities. In assets, it is fixed assets, investment, current assets. Okay. Purpose of a balance sheet: it provides financial information to those loaning money to the business, plus investors, possible lenders, customers, and suppliers. So what happens is that when you look at a balance sheet, generally, what are the things you look at? You can write in this chat box. So from the practical point of view, what are the things you look at? Debt. Okay. Next. Is it that you look at debt only? Reserves. Very good. Fixed assets, cash balances, capital. Very good. Expenses will not come in balance sheet. Expenses will not come. Payables, receivables. Very good. Shareholder equity, debtors and creditors. Okay. But these are individual components of that. Okay. But as a credit underwriter, which I was in my previous assignment for a long time. So the first thing when I used to see a balance sheet, I used to do some mental calculations. So what you are saying is correct. These are individual components of a balance sheet. But as a credit underwriter, at least when I used to look at a balance sheet, I used to do certain mental calculations. What are those? Yes, leverage. Correct. Second, solvency. Okay. What else? We see the cash, total asset, total liability, invoice, leverage, liquidity, fair enough. EBITDA will come from PL. So let's not talk about this. But there is certain relationship with PL which will come here. Depreciation again will come from PL, but yes, definitely if you go to the notes of fixed asset, you will get to know the depreciation. Great. Gross block, fair enough, all turnover ratios. So what happens is that when I look at a balance sheet, I pick up two things, three things. One is debt to equity, right? Tall by, so I should write it, total right, total. I'm not writing in Excel. I'm writing in the chat box. Right. Can you see the message? You can't see the message in the chat box. Okay. Can you see my Excel? Can you see the Excel? Somebody is saying no, somebody is, yeah. So total operating leverage and total net worth. Right? Say this is 200 and this is 50. Then what is tall by TNW is 4. Right. So this is one thing which I say, yeah, there are different leverage ratios that we are going to cover in the next session. When we talk about leverage ratio, there are at least 4 to 5 types of leverage. We are going to discuss this in the next session today only. Okay. This is called tall by TNW, right? This is something which as a credit underwriter, you should immediately look at. Second thing is the receivables turnover. So when we talk about receivables turnover, Bharat, there are different types of ratios which we are going to discuss in the next session. Receivables turnover means my receivables or debtors divided by sales. Right. See, total operating liabilities. It's not leverage, total operating liabilities. Total operating liabilities. So when you look at balance sheet, you know all the liabilities, right? Total operating liability by total net worth. Okay. Now, receivable turnovers is basically, yeah, can I go ahead? Okay, receivable turnovers is receivables by sales. Now, this sales, for this sales, I have to look at the PL account, profit and loss account, right? So when we look at the PL account, so we just understand. So now for an example, I have receivables of say 300. And I have sales of 600. Now my receivables turnover equals to 300 divided by 600 into 365. $182 days. So I have to give credit to my customer for 182 days, right? Which is very high. But yes, that could be normal for certain things. Say government, my customer is government authorities, my customer is a PSU, they can make me payment after 6 months. That is quite possible, right? But yes, if I'm into FMCG sector where the churning is very, very fast, then it cannot be 182 days. If it is 182 days, then I won't be able to survive, right? So these are certain basic things which you look at when you look at balance sheet and you just compare it with peer account also. Another thing is that you check as an underwriter whether the balance sheet is prepared correct or not, whether the assets and liabilities are matching or not. Then another thing is there are certain things which is not apparently visible in the balance sheet, but you look at it. Can you give me one example for that? Contingent liability, what else? You can go to notes, but from notes also you need to deep dive. No. I'm not talking about the qualitative aspect. Not legal. No. So say for an example, have you heard about a term called pseudo equity? Have you heard about a term called pseudo equity? What is pseudo equity? No. Yes. So for an example, in the balance sheet, you get an item like unsecured loans. I'm writing as USL from promoters. In the unsecured loan, there is an item called unsecured loan from the promoters. So that means it's a pseudo equity. If the promoter is giving unsecured loan and not taking any interest for that, that's a pseudo equity which you can calculate in the equity to show that is your leverage is in a good state. Right. For an example, my equity is this much, my debt is this much. Now in that debt, 400 has a breakup. 400 has a breakup of 200 external debt and 200 USL from promoters. Right? So normally if my equity and debt is this, and that is this, what is my debt to equity ratio? It is 4, right? Debt to equity ratio is 4. But actually, is 400 my debt? This 200 is unsecured loan which is given by promoter for which he is not even taking any interest. So this I can consider in equity. So what is my total value of equity? My total value of equity is 100 plus 200 equals to 300 and my debt is 200. Now you see what is your debt to equity. It's not even 1. Yeah, so only if they don't take interest. Now how to understand that whether they are taking interest or not? How do you understand that whether they are taking interest or not? Yeah, so go to the notes and see the breakup of finance cost. If in that it is showing that interest is paid to this particular promoter and the same promoter's name is matching with the breakup of unsecured loan, then obviously you get that he is getting interest and you are not going to consider it in the pseudo equity. But If it is not reflecting, you can consider it in the pseudo equity. So at times you will get proposal where the debt equity ratio is too high, and but it is a genuine case which can be funded. So where you can find out this kind of opportunity to show that no, debt equity ratio apparently it shows high, but actually if you deep dive, the debt equity ratio is much less. So the company is not at all too much leveraged, right? So somebody asked me what is an ideal toll by TNW, though it varies from industry to industry. So if it is a capital intensive industry, it will be more. Normally 4:1 is a perfect one. 3:1 is a good one. Okay. Can I go ahead? Yeah, those keeps on happening, Anand. There are a lot of frauds and scams which are coming out like this, lending money to group company, diverting money from one company to another company. So to understand that, the best part is when we get a holding company, or when we get, yeah, ideally, yes, credit manager should go into it, but real life scenario is you get pressure from, no, pseudo equity is definitely, no, forensic analysis is not something which is included in this course. Forensic analysis is a different ballgame. So, okay. Now, see, at what extent you can consider it depends. That there are companies, see, people make balance sheet based on their mindset, what I have seen, right? There are certain companies which keeps a very minimum capital, and most of the capitals they route it through unsecured loan, and which they show that it's an unsecured loan from promoters. They even show that this is an unsecured loan from a group company. So there are multiple reasons for this. There could be some tax evasion, tax evasion, I will not say, it's a wrong term to use. There could be a tax consideration for this, where you set up a company with in a different country where the taxes are slightly lenient, and you route the fund through that. I have seen a number of companies who have set up office in Singapore, and especially the fintechs who set up office in Singapore, and then they route the fund from Singapore to India. So that keeps on happening, from Malaysia to India. So that keeps on happening. There could be some tax consideration for that. So that is one point where again you will get a loan from a group company, but actually it's a group company, but fund is rooted just in order to take care of your tax portion. So that keeps on happening. But broadly, to answer the question whether a credit manager should look into this or not, yes, credit manager ideally should. So when you are doing an underwriting, so it depends again on the ticket size. So if you are doing what it is given as debt instead of equity means, why it is given as debt instead of equity. Again, I told you there are a lot of tax considerations. So somebody probably had suggested them. Probably it can be their mindset to show that I do not have much money, I am borrowing money, right? Could be there that they are clever enough to show that I have taken this money as a debt, the debt equity concept, but they show it, they form a pseudo company and route the money uh, through some other company, and then again to deflate the profit they show interest also. But as a credit underwriter, you can be, the norms, accounting standard norms, that yes, that if interest is being paid, then at least I cannot take this benefit in calculating leverage. So that is one part. Yeah, they can convert this debt into equity later also. So there can be n number of things. Okay. Uh, Coming to this question, so that whether a credit underwriter should get into this or not. Yes, that's a very important question. To what extent credit underwriter actually can get into in real life situation? If you ask an academic person, he will say, yes, you should probe this, you should probe this, but in real life situation, boss, it doesn't happen. It depends on the ticket size. You are giving a loan of 1 lakh to someone. You do not do a lot of probe into that. Maybe it is a corporate, big corporate. Yes, there is certain standardized underwriting format. You go and check the balance sheet, PL account, banking, GST, do triangulation, and then you check their overall ratios, check their credit rating, and go ahead. But when it is a case of 5 CR, analysis has to be more thorough. When it is a case of 50 CR, then analysis has to be much more detailed with financial models and all. So how much you want to see, how much a credit analyst needs to deep dive is again depend on A, size of proposal, B, the relationship with the client. So if you do too much deep dive and your MD is asking that why are you getting why it is getting so delayed, you have to quickly approve, then there are many things which gets missed out. That's a real life situation for us. That's from my personal experience where I wanted to do a lot of pro, but it was funded and there is a pressure from the top management. You have to go ahead and fund it. Oh, if you want to see too much of things, then your boss will come say, hey, you don't need to see all these things here. Just go ahead. Okay, so it happens in real life situation. So to what extent you can go is dependent on, one is your ticket size, second is your client profile, third is your aggressive company's aggressiveness. See Bajaj Finance, you look at Bajaj Finance, the kind of funding they had done. Okay, ICICI will not dare to, they will not dare to do that kind of funding. Yes, ICICI had done, once upon a time, they had come up with a product called short-term personal loan, 30,000, 40,000 loan given to the rickshaw pullers even. But that was not available to everyone. That was available to only few people who had the Oh, sorry, I was on mute. Sorry. Am I audible now? Okay. So this is a comparative analysis for balance sheet for Apple Inc, where you can see current assets, non-current assets, current liability, non-current liabilities, all these things are there. for 2 consecutive financial year, I'm not going to ask you what is cash and cash equivalent because I expect those are known to you. I would give you 5 minutes to quickly observe and give certain pointers that what do you observe in this. Just take 5 minutes, study the balance sheet and put the pointers in the chat box. What are your observations? Take 5 minutes for reading the balance sheet thoroughly. Can you start the discussion? So Bharat is writing total debt increase, equity down. Let me read. 1 second. CA covers CL. Okay. Long-term debt has increased from 91 to 98. Okay. Net worth has declined. Yes. Strong investment in marketable securities for short-term and long-term. Total debt increase, equity down, which means leverage has increased. Not good. Okay. Next, Abhijit Kumar is writing cash has declined from prior year. Very good observation. Strong invest in marketable securities for long, short-term and long-term. CA covers CL. LT debt has increased from previous year from 91 to 98. And net worth has declined. Lower AR and what is AR and AP? Accounts receivable. Abhishek is accounts receivable and accounts payable, which is good in terms of good working capital management. Good. Account receivable is decreased. Yes, true. Retained earnings gone down, which means distributed back to shareholders through buyback of dividend. Okay, good one. Good observation. Reduce non-current asset fixed to increase. Now, when non-current asset is reduced, no, that is also not happening. Okay. No, I would not say, Arindam, what you are saying, reduce non-current assets to increase cash equivalent. Cash equivalent has not increased. Cash equivalent has decreased rather. Look at 2020, it is 38. In 2019, it was 48. Sorry. Current ratio, okay, has declined. Good. You have calculated that. Better working capital management, shareholders' equity reduced. Yes. Shareholders' equity reduced. Who said shareholders' equity reduced? Shareholders' equity has gone down. Yeah, total shareholders' equity has gone down. That is gone down because of the reduced retained earnings. That has gone down mainly. So again, you have to dip down. It has gone down because reduced retained earnings. The retained earnings was 45,898 in 19 and it is 14,966 in 20. Okay, good. Anand, you have mentioned it's less fresh investment. Now, I would like to ask you one small thing. There are certain aspects which are not that great, especially when the Bharat is asking, this shareholders' equity is cost or market value? No, this is cost. Market value could be different. So I'll tell you, there is a basic difference between your total net worth or total equity between your market value. Because market value comes to, it is capital infused or existing capital plus the actual term will be existing capital plus capital infused. So when I talk about this is actual capital plus capital infused, right? Now, a question which you have asked is very, very important. Whether my market value will be equal to my equity value. That's a good question. Now, my question to you is, my answer is no, it might not be. Now, why I am saying no, can anybody answer this? This is applicable only for a listed company. Now, my answer is no, it might not be equal. So when I talk about total equity, and when I talk about market capitalization, these two might not be equal. Why it will not be equal? Correct. So market value keep changing on everyday basis and also depends on market sentiment. Now, at times it might happen that your market capitalization is less than your total equity, or your market capitalization is far, far, far better than your total equity. Okay. PE ratio is something different. That is price to earning ratio. Those are different. Those are exclusively for listed companies, and it is needed for valuation or for a high value underwriting. Okay. So good observation, guys. Next is we'll go for the profit and loss account. So profit and loss account, as we know, then again, it's a very basic thing. The components are revenue, operating profit, cost of goods sold, operating income, gross profit, other income, expenses, and profit. So this is something which is known to all of us. Nothing new in this. Okay. Again, what is the objective of profit and loss account? To know the trading results. So when I talk about trading results, why we need to know the trading results? Somebody asking, is the market cap same as total equity? No, it might not be. It might not be, because market cap is sum total of all your equity price. So your equity price today into number of outstanding securities, it gives you a total market capitalization. So for an example, I have 1,000 securities, 1,000 shares in the market outstanding with a price of 30. So my total market cap is 30,000, but my equity could be 25,000. Why this two is different? Because that happens based on my market sentiment, how I am performing, how there is a change or doldrum in the sector which can positively or negatively affect my company, my overall business. Probably there is something in news for me that I'm going to get a contract which can shoot up my top line. So all of a sudden my share price can shoot up. All of a sudden something can happen which can, pull down my share price. So market capitalization and your total equity might not be equal. I hope you understood, right? Okay, let's go ahead. Now, just let me understand, to know the trading result, how it is significant. When we talk about objectives of profit and loss account, we talk about to know the trading result, how it is important. So total equity is not computed on a particular day. Total equity is computed on the last day of the financial year. Market capital can be computed regularly because your share prices changes. Yeah, sale price versus cost price, one thing. Second thing, if we refer to trading account, I need to understand what is my operating margin. Next is to check the overall profitability. When I talk about overall profitability, that means my admin expenses are my entire sales net of all the expenses, including my admin expenses, my finance cost, my tax, everything. To know the expenses. Now, why do I need to know the expenses? Why do I need to know the expenses? Can somebody write in the chat box? To know the expenses, why do I need to know the expenses? Net profit calculation, one thing. Second thing, that is known to us. Fair enough. What else? Ratios. Okay. Right, Bharat. To have a control over cost. So when I know my expenses, I can understand that what is that particular item which is reducing my profitability, or what are those set of items which is reducing my profitability, so that I can have a check on that. So for a particular, say in a particular PL account, I can see my electricity bill is too high, too much high. So when I talk about too much high electricity bill, then I go and deep dive for the electricity bill that I have paid on a month-on-month basis. Now I can see that for 4 to 5 months in a particular year, the electricity bill was shot up like anything. Then the next step is I would like to deep dive into it and understand that why in those months my electricity bill had shot up like this. Probably I can find out something and I can take a corrective action of that, right? So this is just an example. It could be electricity bill, it could be wastage and pilferage of materials, it could be excessive manpower cost, it could be anything. So just to know and identify, do a root cause analysis and take a corrective action. That is the reason for which we need to know the PL account. Yeah, you can do it every week. You can do it on an everyday basis. Today's sale versus today's cost. You can do it. Right? So the last and not the least point is the objective of this is to control the unnecessary expenses. Next is again the same exercise for 5 minutes. Quickly go through the profit and loss account and give your observation on this. Though it's not a, this is again a, no, this is not a comparative analysis. Just give your observation on this. A particular time, 1st April 20 to November 18, November 20, the entire transactions has been captured here and a profit and loss account is drawn. Please give your observation. What do you feel? And anything, if you can calculate something, some ratios related to PL account. Have a look for 5 minutes. Okay, one observation, Bharat. So we will go for a deeper analysis for the balance sheet. We will take up one balance sheet, PL account. We'll do that. Good. some more critical observation, please. Yeah, so what? Let it be for 8 months. Let it be for 2 months. Let it be for 1 month. That doesn't matter. What I expect is some critical observations more. Correcting a ratio is okay, fair enough. Anybody can do it. But what are some critical observations? Look at the expenses. Look at the expenses. So can you see one thing? The first highest indirect expense, that is 2,55,000. So if I break up, I can easily see the breakup of components of indirect expenses. The first highest one is salary. Next one is rent. Now salary could be because something which cannot be controlled. But rent is the second highest, that is 1,05,000, which is something a big amount among the total. Yes, salary and rent. So probably if the management wish and if it is possible, then probably they can take a corrective action in this. Okay. Now, once we do that, I am sure you got the balance sheet financials of two companies. So we'll pick up any one today. And we'll start discussing about the comparison, which has gone up, which has gone down. And then you will be given a task to find out different ratios. So that is at a later stage. Okay, can I go ahead? So again, 9% could be high or 9% could be low. That depends on the industry benchmark. I do not think 9% is too high because you are right, Muni Raju. Breakup of rent might be needed. It could be due to something like go down cost where the worth considering it rent can be augmented by purchasing price. Understood. And probably the go down because they are into the computer sales, probably it is an air condition go down, AC go down. So where the cost is adding up. No, there is no such guideline. So it is totally depending on you, but definitely there are certain CAGR on an industry to industry basis. There are certain profitability ratios and different ratios which depends. But then again, it's not guidelines. When we talk about guidelines, there is a difference between guideline and benchmark. So benchmark is this, whether you could achieve this or not is something else. So suppose my benchmark is selling 100 accounts, 100 CASA today, or in a month, I could sell 50. So that is something else. That is a target. And guidelines means you have to comply. So you have to maintain this kind of profitability, which is again not in my hand, right? Another thing, did you observe in the PL account? Okay, one sec. Yeah, 23% GPM is definitely good one. So when I talked about the balance sheet, there were certain bad things which has happened in 2020, 26 September 2020. Okay, reduction in cash equivalent. What could be the reason? What could be the reason for the current financial year if I'm considering? What could be the reason for reduction of cash and cash equivalent? You are missing a major thing. Look at the date. Again, you are missing a major thing. Look at the date. Yes, Sanjay, yes. COVID was a major reason. This balance sheet is made on 26th September 2020. And it's a real balance sheet of Apple. When COVID came, COVID was in full swing at that time. First wave was going on. That is the reason. That's the reason. Okay. Next is very important in credit underwriting is cash flow statement. Now, there are certain purpose of cash flow statement. One is understand the liquidity. So when you talk about sales, profit, everything, so sales comes on an accrued basis, but cash flow gives me a fair amount of understanding how much cash we have. So how much cash and cash equivalent I have, that gives me the true picture of liquidity, right? Then it also gives me a true picture of my capital expenses. Because in my cash flow statement, I got to know, or we get to know that how much capital expenses were there. Next, it helps in my business valuation because in tomorrow's session, when I'll go for discounted cash flow method, so our cash flow statement is very much important. In future, cash flows will be discounted. So it helps in business valuation. So when I talk about business valuation, has anybody seen any episodes of Shark Tank? Shark Tank. So have you seen that there was a concept where the startups, they come to the investors, they place their proposal, and they come up with a figure that is called valuation, right? The concept in details we will discuss tomorrow. How is that valuation arrived? Multiplier to sales, generally they don't do. Generally they go for discounting the future cash flow. Generally, it's an option, obviously, but generally what they do, discounted cash flow method. Future cash flow, but then they discount it and then club up. Yes, DCF, right. But the basic of DCF is again cash flow. Right. So cash flow statement, if I understand properly, then I will be able to understand or calculate the cash flow statement which are readily available for this up to this current financial year and also for the projected financial years, and which we can discount and find out what is the total present value of the entire thing, and accordingly I can ask for any investment. Right. So business valuation is something where cash flow is used. Coming to treasury stocks, when a company repurchases its own shares and holds them as treasury stock, it typically involves a cash outflow. So my shares are circulating in the market, it is listed in the share market. I have repurchased it. So there is a cash outflow, right? My equity increased, but again, my cash balance has decreased. Then dividends, which causes my cash balance to get reduced. Could be potential red flags when we look at the cash flow statement that this is where I'm spending extra. Spending extra means, now tell me one thing. When I talk about potential red flags, where I'm spending extra, you can get from PL account as well and cash flow. Now, how cash flow is beneficial compared to PL account to identify those red flags? Even PL account gives you an idea. Okay, Anand, I didn't know this. Thank you. Yes, PL is on accrual basis. Cash flow is real cash outflow. So if my cash balance is reduced, then Arvind, I didn't get your question. Cash flow tells under which activity means? Can you just elaborate your question, please? So the total thing clubs up to a cash flow statement. Investing operation. So under which activity money spent or received depends on the type of activity. So I'll show you a cash flow statement in the next slide. Then you will understand. Okay. And it gives us the overall financial health of the company. Now look at this cash flow statement carefully. Arvind, this will answer your query. That what kind of expense will come under what head in the cash flow. Bharat, I didn't get your question. Gross cash firm income. So where personal is not club. Depends on the type of operation this farm is into. Like where from you felt that it's a personal one? Okay, that's something is written. Probably it has been made like this. That's okay, fair enough. Ignore that. Just understand the focus on the cash flow statement. So probably that's a thing which ideally should not come. Then that's a good observation. Could be it's a proprietary firm. Okay, where they have incorporated all these things just again to deflate the overall cash. What are the other observations? Yeah, heavy capex done, it is because of purchase of machinery equipment. It can happen for one point of time. Probably the machines were to be replaced. But again, there is one thing. Could be there was extra order for which new machines needs to be purchased. Yeah, 12% increase in cash at hand. Okay, anything else? This is a good observation. Money borrowed to principal payments. Even family living expense is there. Yeah, that's okay, fair enough. Like he could have arranged fund, he could have taken from somewhere else as well. Not the entire borrowing money could cover the entire principal payment. Yeah, that is definitely true. It's not a good idea, and this is not also a corporate cash flow statement. Could be for a proprietary firm was clubbed together. So interest cost is not there because they have uh, uh, either not shown it in the cash flow. Probably the one who has made it is not that skilled enough. Could be in no repayment was done for the COVID period. So naturally interest was also not paid. That could be another one, another possibility. Okay, can I go ahead? So this is a typical trend analysis. Just carefully look this, you will understand quarter-wise performance. This is how we present data in Power BI. or Tableau even. So both Power BI and Tableau are data visualization tools where we can present data like this. Muniraju, it can be possible. Probably the way things are unorganized in the cash flow statement, it is possible. No, it can't be shown here that how to do it in Power BI. This is pure technical thing. You need to have the data. You have to either upload in the Power BI, or if you have a data source, you do an API integration through which you push the data and then you show it in the Power BI. So it cannot be shown like this. This is just for your understanding how to do this, how to read this trend analysis. As a credit analyst, you don't need to do this thing. You have to read and understand this thing. This will be already available to you. You don't need to do this. So you can see first quarter 2020 sales performance versus 2021 and 2022 sales performance for first, second, third, and fourth quarter. Similarly, revenues, similarly, graphical increase in earnings per month in year 2021 and earnings per month. One is earnings per month, another is increase in earnings per month. The trend shows it's good. Okay. So, but then if it is to be submitted to management, I don't think it's it comes under credit underwriting. So as a credit analyst, you can get these tools, and currently what is happening is this manual underwriting process is almost getting obsolete slowly and gradually. So there are companies like Perfios, other companies like Novel Pattern, Fineza. They do the entire analysis of financials and put it to you in a graphical manner, and you just have to look at it and give your opinion on this, whether to go ahead or you reject it. That's it. So it's not required like for credit underwriters. Perfios is there. So I'll write these companies. Perfios, you can check their software. Perfios is the best one. Check the software. Check the website, in fact. Perfios you can check Novel Pattern. But do check Perfios. That's the best one in India. So they are integrating with all banks and services. So earlier what we used to do manually, do this, what do you say? This financial statement analysis, which is currently happening in an automated mode. So you just have to upload the PDF. They will read by OCR. They will do all the analysis. The machine will do, and it's a kind of AI and ML activity. Then they will present it in this format. But definitely, as a credit underwriter, you need to have your basics very, very clear. Bharat has asked me a very, very important question. So, to some extent, yes, and no also. So, if you are upgrading your skills, then obviously it's not. If you are only doing repetitive jobs like a file is coming, I am underwriting, I am recommending, or I am approving, then obviously you are going to get obsolete. So increasing earning percentage is basically the amount I earned last month and amount I earned this month. What is the increase in that in percentage terms? It's on a month-on-month basis. Okay, can I go ahead, guys? So currently, I'll tell you in terms of capability, companies like Perfios is going into granular analysis of the balance sheet. So you won't believe, if you see their analysis pattern, they get into so granular. Okay, they get into so granular things that honestly speaking, a human intervention is not even needed. Human intervention is not even needed. Okay. Next, I'm going to discuss Dupont analysis. Dupont analysis is basically it's a model to calculate return on equity, right? So there are three things which is required in Dupont analysis. One is your net profit margin, another is asset turnover, another is equity multiplier. So we'll check and quickly check the formula. This is return on equity based on Dupont. Net income by revenue is net profit margin. Revenue by average total assets is your asset turnover, and average total assets by average total equity is your total equity multiplier, right? So to make it more simple, there is an extended Dupont analysis. I'm going to show you this. So extended Dupont method is interest burden ratio, income before tax by operating income, and then net income by income before tax. That is tax burden ratio. So what happens? Operating profit margin is operating income divided by revenue, and asset turnover is revenue by average total assets. Financial leverage is average total assets by average shareholders equity, right? Then what happens? There are certain items which are diagonal and so getting strike off. So income before tax done with income before tax. So what comes is net operating income done with operating income, revenue done with revenue, and then ultimately what we get is net income by average shareholders equity, which gives you, anyhow, it gives you ROE, that is return on equity. So this is a Dupont analysis, which is shown here. So that was the last part. Can you quickly refer to the balance sheet financials that I had sent to you guys? I think seminar 1, AFCONS. Open the AFCONS financials and go to the balance sheet. This is the balance sheet, page number 36. Page number 36. See, I cannot resend it. It has already been sent to, it has been already sent to Equalify. Please take it from them. I cannot resend it. You have to take it from them. I think everybody has already received it. If you have not received, please take it from them. Yes, Bharat, tell me. Okay, then take it from WhatsApp group. That's okay. Okay, Bharat, I understood your question. So both the analysis is extremely needed, if especially it is for a high ticket size analysis. Why it is needed? Because you can see the intra transfer of fund, the routing of fund, everything. So it is very important to see the both the consolidated as well as the standalone. right? Okay. Now quickly have a look on these financials. I can zoom a bit and give your observation. I'll give 5 minutes. We have to quickly wrap up and we have to start the next session at 10:30. Just have a look and quickly give some observations. And then the task for the day will be to calculate the ratios. I will not ask you to, but present it in a proper manner, like a comparative analysis for different items. Right now, you can verbally tell me, but at least present it in a comparative analysis where there is increase, where there is a decrease, and with your comments. That is going to be the task. So tomorrow when we start our session, probably around 10-15 minutes, we will discuss on that. So quickly give your observation, what you are observing here. If you have received this, please open it, go through it, and quickly give your observation in the chat box. Yeah, guys, quick your feedback, please. Okay, one feedback. Second is, next feedback is, okay. That's a good thing. Trade receivables reduced. Okay. Okay. So the task for today is like tomorrow you are supposed to bring this is, so make a comparative. Let me clear this first. So make a comparative analysis on the financials of two consecutive financial years and your brief observation, right? So just a couple of observations. It is better if you can mail me. I'll talk to Equalify that if they are allowing you, or else you can mail it to Equalify today by night, so that tomorrow at least a few observations I get it, and probably we can have a discussion for 10-15 minutes, and then we will go for the next session. So yeah, balance sheet, PL account, and cash flow. Whatever your observations are, normally you put it like this. Okay. Just tomorrow to start with, we will discuss. And those who have not received this financial, please take it from the WhatsApp group, or anybody, you can ask from Equalify as well. Right? Anything else, guys? Can we quickly wrap up, because again we have to restart at 10:30.